The chair sees no other members who have opening statements. Now it is my pleasure to introduce panel one this is a two-panel hearing, and panel one consists of the Honorable Michael Barr, who's the Assistant Secretary for Financial Institutions at the Department of Pleasure. We want to welcome Mr. Barr back to this committee once again. And also joining him at the witness table is someone who is very familiar to this subcommittee, the Honorable John Libowitz, who is the Chairman of the Federal Trade Commission. And Chairman Libowitz, we certainly welcome you back again to this subcommittee. It is the practice of this subcommittee now to swear in the witnesses. So I would like for you, each of you, to stand and raise your right hand. Yeah. Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? Let the record reflect that the witnesses have answered in the affirmative. Now we want to recognize, beginning with Mr. Barr, the witnesses for an opening statement. You have 5 minutes or thereabouts for your opening statement. Thank you. All right. Mr. Barr, you're recognized for 5 minutes or thereabouts.
Thank you, Mr. Chairman, and thank you, Ranking Member Radonovich, for providing me with this opportunity to testify about President Obama's proposal to establish a new, strong financial regulatory agency charged with just one job: looking out for consumers across the financial services landscape. As Secretary Geithner has said, protecting consumers is important in its own right and also central to safeguarding our financial system as a whole. We must restore honesty and integrity to our financial system. That is why President Obama personally feels so strongly about creating this new Consumer Financial Protection Agency. I understand the committee's concerns that have been expressed today with respect to boundary issues, jurisdictional issues, and the role of the FTC. I think as we work together on those issues, it's important to keep in mind the central goal we all share: having one agency for one marketplace with one mission, protecting consumers. The new agency will have the authority and the resources it needs to set consistently high standards for banks and non-bank financial providers alike, to put an end to regulatory arbitrage, to put an end to unregulated corners of our financial system that inevitably weaken standards across the board. This agency will be accountable for its mission, yet independent. It will have a wide range of tools to promote transparency, simplicity, and fairness. It will act in a balanced manner, considering costs as well as benefits, in a way that protects consumers from abuse while ensuring their access to innovative, responsible financial services. It will be able to reduce regulatory burden while helping consumers. For example, by creating one simple mortgage disclosure form for all consumers to use. It will not set prices for any service. The federal government has failed to date in its most basic regulatory responsibility, utterly failed to protect consumers. The deep financial crisis that we are still in, let me emphasize that we are still in today, revealed the alarming failure of our existing regime to protect responsible consumers and to keep the playing field level for responsible providers. Instead of leadership and accountability, we have had a fragmented system of regulation designed for failure. Bank and non-bank financial service providers compete vigorously in the same consumer markets, but are subject to two different and uncoordinated federal regimes, one based on examination and supervision, the other on after-the-fact investigation and enforcement. Less responsible actors are willing to gamble that the FTC and the states lack the resources to detect and investigate them. This puts enormous pressure, too, on banks, thrifts, and credit unions to lower their standards to compete and on their regulators to let them. And no financial provider should be forced to choose between keeping market share and treating consumers fairly. This is precisely what happened in the mortgage market. Independent mortgage companies peddled risky mortgages in misleading ways to borrowers who could not handle them. To compete, banks and thrifts and their affiliates relaxed their standards on underwriting and sales, and their regulators were slow to act. The consequences for homeowners were devastating, and our economy is still paying the price. Fragmented regulation facilitated abusive credit cards. Tricks and traps enabled banks to advertise selectively low annual percentage rates to grab market share and boost income. Other banks could not compete if they offered fair credit cards with transparent pricing, and consumers ended up with retroactive rate hikes and unfair terms. The list goes on and on. Credit unions and community banks with straightforward credit products struggled to compete with less scrupulous providers who appeared to offer a good deal and then pulled a switch on the consumer. Our federal agencies do not currently have the mission, structures, and authorities suited to effective consumer protection in consumer financial markets. The FTC has no jurisdiction over banks, and it does not have the supervisory and examination authority to detect and prevent problems before they spread throughout the market. Mr. Chairman, I see that I will be significantly over my time. Could I take several additional minutes?
Yes, you so approved.
Thank you.
You're on your thereabouts part of your testimony.
Thank you. Bank regulators have supervisory powers over banks, but their primary mission is to ensure that banks are safe and sound and not to protect consumers. Consumer protection supervision is never going to share the front seat with safety and soundness. Tinkering with the consumer protection mandates or authorities of our existing agencies cannot solve these structural problems. We need a structural solution. We need one agency for one marketplace with one mission to protect consumers of financial products and services and the authority to achieve that mission. That's the agency we are proposing to create. The CFPA will have the sole mission of protecting consumers. It will write rules, supervise institutions, examine them, and lead enforcement efforts for the whole marketplace. The implications for our proposal for consumer protection and competition are enormous. The proposal will bring higher and more consistent standards, stronger, faster responses to problems, the end of regulatory arbitrage, a level playing field for all providers, and more efficient regulation. Our proposal gives the agency the power to strengthen mortgage regulation across all lenders and brokers. It can strengthen disclosure, make it easier for consumers to choose simple products, prevent lenders from paying yield spread premiums that pay brokers more if they deliver loans with higher rates than consumers qualify for. The agency would implement credit card protections and update these protections as markets change. And it would set high national standards for licensing, bonding, monitoring of all non-bank financial services providers. Let me say, the FTC is a good agency. The chairman and I are good friends. Our legislation does not affect the jurisdiction of the FTC over the vast array of non-financial markets and actually strengthens its ability to police those markets. To increase the FTC's ability to protect consumers, we propose that the FTC be able to adopt rules to prohibit unfair or deceptive acts or practices with standard notice and comment rulemaking, to obtain civil penalties when companies act in an unfair or deceptive way, and to pursue those who substantially aid and abet providers that commit unfair or deceptive practices. The administration also supports increased resources for the FTC so that consumers can be better protected across all markets. As for financial markets, the FTC would continue to have authority under the FTC Act to pursue financial fraud without delay, including on foreclosure rescue and loan modification scams. The FTC will retain authority for writing rules under the Telemarketing Sales Act and concurrent responsibility for enforcing them over financial products and services. And the FTC would retain primary authority in the area of data security for non-bank entities. In addition, the FTC would have backstop authority to enforce the same consumer credit statutes that it can enforce today. Under that authority, the FTC, or frankly a bank regulator, could, if it becomes aware of a possible law violation, refer it to the new agency, and if the new agency doesn't act, take action itself. That same referral requirement will apply to the bank regulators, and it is designed to ensure a consistent federal approach to interpreting and enforcing our consumer protection statutes. Finally, let me just say this. It is time to put consumer protection responsibility in an agency with a focused mission and comprehensive jurisdiction over all financial services providers, banks and non-banks alike. It is time for a level playing field for all financial services providers. It is a time for an agency that consumers and their elected representatives can hold fully accountable and responsible for consumer protection in all financial sectors. And it is also long past time for a stronger FTC. The President's legislation fulfills these needs. Thank you for this opportunity to discuss the proposal, the additional time you have graciously given me, and I will be happy to answer any questions at the conclusion of our opening statements.
Mr. Chairman, I would like to make a unanimous consent that the gentleman from the FTC have 9 minutes.
I believe I'll be giving back at
The chairman of the FTC would take whatever time he may consume.
We've been having a little problem with the microphone. Chairman Rush, Ranking Member Radonovich, Vice Chair Schakowsky, members of the subcommittee, I appreciate the opportunity to be here to discuss consumer protection regulatory reform, including President Obama's far-reaching proposal to enhance consumer protection through the creation of a new Consumer Financial Protection Agency, the CFPA. As all of us in this room know, and as many of you on the panel articulated, and as Mr. Barr also effectively articulated, the need for reform has become as painfully clear as the distress that consumers are now experiencing in these difficult economic times from the failure of regulation. All of us on the Commission support the President's goal of elevating consumer protection, although some of us have different views as to the best means to that. Thank you so much. You see, we are good friends. Although some of us have different views as to the best means to that end. For my part, this initiative, which enhances the resources and authority for the FTC and which creates the CFPA, is clearly preferable to the status quo. In any case, the Commission will continue to vigorously protect consumers of financial services while this proposal is under discussion. CFPA, if it's enacted, is ramping up. Beyond that, we look forward to working collaboratively with the new agency. Thank you so much. Now I feel like I'm at a press conference. In the last 5 years, we've brought more than 100 financial consumer protection cases and have recovered nearly $500 million in the last decade for consumers. Since I last testified before the subcommittee in late March, we've continued aggressively pursuing financial predators, bringing 14 new cases in this area. In fact, today we're announcing distribution of an additional $8 million in consumer redress checks to Americans who were deceived by deceptive mortgage origination fees. And on June 1st, using the new APA rulemaking authority that you gave us in the Omnibus Appropriations Bill, we began our rulemaking addressing mortgage modification and foreclosure rescue scams, which have become, as all of you know, all too common recently, and also addressing the entire mortgage life cycle, advertising, origination, appraisals, and servicing. Simply put, this work will help ensure that consumers aren't ripped off by bogus mortgages or false advertising. Mr. Chairman, President Obama emphasized the importance of giving the FTC tools and increased resources, the ones that we need to stop practices that harm consumers and violate the law. First, the proposal grows our agency, giving us the staff that we need to do the job that you all want us to do. Currently, we have just over 1,100 FTEs. That's down from about the 1,800 FTEs we had in the late 1970s and early 1980s, despite a considerable growth in the U.S. population and in our own responsibilities, including enforcing canned spam, do not call, COPPA, the Children's Online Privacy Protection Act, Gramm-Leach-Bliley FACTA, and other statutes. Second, the proposal provides the FTC with APA notice and comment rulemaking, which is used by virtually every other agency in the federal government. It would strengthen the Commission's ability to address widespread problems more quickly. Third, the proposal authorizes the FTC to obtain civil penalties for violations of Section 5 of the FTC Act. This new power, we believe, would help deter would-be violators and help consumers help protect consumers more effectively. I think something like 47 state attorneys general have fining authority. And by the way, fining authority was originally proposed by Caspar Weinberger when he was chairman of the Federal Trade Commission under President Nixon in the early 1970s. Finally, the proposal authorizes the FTC to go after those who aid and abet others who violate the law. We'd also urge Congress, as you consider this legislation, to give both the FTC and the CFPA the ability to bring civil penalty actions on our own, which would put both of us on equal footing with other consumer protection agencies like the SEC and the CFTC, and not make us, as we do, currently have to wait for the Justice Department to clear our going forward. Now, we expect that, as with any bold and complex new initiative, clarifications will be worked out as the legislative process moves forward. But from my perspective, the President's goal of streamlining the overall system for protecting consumers from financial abuse is more than commendable, and eliminating the balkanization of consumer protection oversight over non-banks and banks, as Mr. Barr has alluded to, is laudable and very, very critical. We do have some concerns, however, about the draft legislation, or the legislation in its, as it was initially drafted, although I'm optimistic that we can work these out as the legislative process moves forward. So, for example, the proposal states that the FTC would have backstop authority, but the draft legislation imposes a review period that could require us to wait 120 days before filing certain cases. We also believe it would be helpful to make definitions of the proposal's terms, such as credit and financial activity, clearer. And let me tell you why with an example. So suppose the FTC finds a telemarketer making illegal robocalls to millions of consumers on the Do Not Call registry, urging them to purchase something like advance fee credit cards, which are, I wouldn't say per se illegal, but almost always, but let's say often illegal. And suppose that a payment processor participated in the fraud. It is critical that we be able to bring an action against all of the malefactors expeditiously. But it's unclear under this draft whether we'd have the jurisdiction over the telemarketer offering the financial products or the payment processor, and if so, whether the 120-day waiting period would come into play. Now, we've made much progress with Treasury on several of these boundary issues, and we're continuing to make progress. But getting this right and allowing us to put an immediate halt to harmful practices is crucially important. Having said that, with this committee involved in writing any legislation, I am confident that this very, very important initiative will be considered, discussed, clarified, and refined, with all open issues resolved in favor of American consumers. We understand, of course, that under this proposal, rulemaking authority and primary enforcement responsibility for financial products and services would go to the new agency, but we will continue to aggressively enforce these laws as a cop on the beat where necessary, as well as each and every other consumer protection law within our jurisdiction. We look forward to working with the administration and Congress to reach a plan that best protects American consumers, and I thank you for your time.
The chair
Happy to answer questions.
Yes. The chair thanks the gentleman, the chairman of the FTC, and the chair now recognizes himself for 5 minutes for the purposes of questioning the witnesses. With the continuation of the financial crisis, we see more and more scam artists preying on desperate consumers seeking to reduce their debts and to keep their homes out of foreclosure or from selling their homes at a loss. And I'm concerned about this proposal in that this new agency will not do enough in the short term because we all know that it takes some time for a new agency to rev up, to get going and to get running. Another option that the administration might have considered is proposing that the FTC take on this essential role and have, by increasing its staff and authority, it's conceivable that the FTC could be taking on these issues within weeks or months rather than years. Mr. Barr, did the administration consider other options other than creating a new agency?
Yes, Mr. Rush. Let me just say, Mr. Chairman, that with respect to the transition issues, our view is that the FTC should act aggressively, as it is doing now under the chairman's leadership, to continue to enforce the law, be a cop on the beat, be quite aggressive in this area. And we are, at the same time that we are pushing to create the new agency, pushing on all the existing agencies, working closely with them to do everything we can under existing authority. So I don't think there's any sense that anybody thinks we should slow down, rather quite the opposite. With respect to other options, the administration considered a wide range of options with respect to consumer protection. And our basic view was that the existing system was fundamentally broken, and we needed a quite large, significant change to create one agency whose sole job was protecting consumers across the financial services marketplace. I think that the chairman is deeply aware of the ways in which consumers have been abused and neglected for quite a long time, and the existing structure is just inadequate to meet the needs. So our strong view, the president's personally strong view, was that we needed a new financial agency with that core mission that was strong and could achieve the goals that I think that the chairman articulated so eloquently in the opening remarks.
Chairman Leibowitz, during this interregnum between this bill becoming law and implemented and this new creation actually taking place, that's going to put a lot of more pressure on the FTC. Do you have the requisite resources and personnel? How will the FTC function during this interregnum?
Well, I would say that during the sort of interregnum period, if the legislation is enacted, we're going to work very closely with the new agency. I think the period for transfer is somewhere between 6 and 24 months, depending on how quickly they're ready to ramp up. We're going to continue to bring cases. I do think it's, and I think that was always the notion. I do think that going forward, we could use more resources, and we've talked about this before in hearings. And I do think that even after the agency is created, assuming it is, that it would be useful for us to have concurrent enforcement authority, so that if we're going after, the bad guys don't always act in silos, as Mr. Barr knows and as all of you know. Sometimes they're violating the do not call rule, and they're violating Reg Z or Reg E, which would go over to the new agency. And so I think it's important going forward that when there's ongoing consumer harm, that we're able to sort of jump over the kind of legislative, the new legislative fence to help consumers and not have to wait potentially 120 days. I think we're working through a lot of these issues and making a lot of progress between our staffs and ourselves.
The chair sees that his time is up. The chair now recognizes the ranking member for 5 minutes.
Thanks, Mr. Chairman, and welcome, gentlemen, to the panel. I'm pleased to see you here today. Mr. Leibowitz, and welcome back to the committee. I know you've been here a number of times already and probably will be more in the future. I got to think you're doing a bit of a dance because you stand to lose some jurisdiction in the FTC. And it seems to me that you're getting, or at least under the proposal, getting more money and authority to do less. And I want to know what your reaction to that statement is, given the fact that the FTC has dual jurisdiction, and that is 2 missions, to ensure competition, but also consumer protection.
Well, Mr. Radonovich, let me just start by saying I hope that familiarity is not breeding contempt here.
Not at all.
And,
not at all.
Look, if you read through our written testimony, you can sort of see it's a complex matrix within the commission about what we support and what we don't. I do think from our perspective, if you create this, from my perspective, if you create this new agency and you also give us more resources and authority, from the perspective of consumers, they will be getting a better deal because we'll continue to have a backstop authority with respect to financial matters. And we're going to be able to concentrate and just do more for consumers. As you know, and because we've talked about this, we spend a lot of time
But
leveraging
if I
our
may,
limited
but you
resources.
are losing jurisdiction.
We would be losing jurisdiction, and we'd be
Then
losing
how
FTEs.
does that loss of jurisdiction deal with your two missions of ensuring competition and providing consumer protection?
Well, I would say on the competition side, we wouldn't be losing jurisdiction. We'd still retain that jurisdiction. On the consumer protection side, we would be losing jurisdiction to this new agency, but this new agency would be another cop on the beat protecting consumers, and we'd also be losing personnel. We have and we have already lost a few personnel, I would say, to the new
It
agency.
does seem to me like you're getting more money and authority to do less.
Well, we'll do more. I mean, we really will. It's not a question from our perspective of moving to a government sinecure. I mean, our guys work extremely hard. They've been commended by OPM for always scoring high on sort of effectiveness and quality of work. And we'll just do more in the areas where we have, while retaining backup authority, if the proposal goes through, we'll do more in the other areas of consumer protection, and there's plenty to do.
Thank you. Thank you. Mr. Barr, welcome to the subcommittee. In Russia, during the height of communism, it was often talked about the fact that there was not a lot of food on the shelves. And when you go into stores, you might be able to get a loaf of bread, but if you wanted sourdough, you probably had to have the standard loaf. If you wanted rolls, you got a loaf of bread. If you wanted something else, you got a loaf of bread. Explain to me how you're not doing the same thing in the credit markets in the name of consumer protection.
Thank you very much for that terrific question. I was smiling because as you were describing the example, I spent some time in Poland and had the same experience where you go to the store and there's nothing there and you can actually literally go hungry. This agency has nothing to do with that. Literally nothing to do with that.
Tell me how
So
you're not doing that, though, in the credit markets. Then that would be the question I'd like answered.
The new agency is in no way pursuing that kind of command and control model. It's in no way pursuing price setting. It's in no way saying you can't offer certain kinds of products. The new agency under the legislation.
And I understand the reason for looking at this because we've all, experiencing this financial crisis, but doesn't this end up providing consumers with less choice and driving up the cost of credit for consumers?
With respect, sir, our strong view is that it does not. It continues to provide for financial innovation. Consumers can get access to whatever products and services providers want to offer. Our basic approach is to improve disclosure, reduce regulatory burden, for example, by merging TILA and RESPA authorities. You can have one simple mortgage form at the time of disclosure.
But
improve.
Weren't there existing authorities that have and could and should deal with the current crisis that we're in? Doesn't the added restrictions and regulations that you're going to be putting on the credit industry will drive up the cost of credit to consumers?
I think that the better judgment, sir, again, with respect, is that the current system we've had, the status quo on consumer protection, was a dismal failure. And I think we have evidence all around us of that. And our view was, both for banks and for non-banks, for consumers and for households, the system failed. If you talk to, I'm sure you do, the community bankers in your community who had to compete against unregulated providers who were sucked into
Actually,
offering
they're
products
competing
that
against
they don't
large
want.
banks for TARP money, but thank you very much, Mr. Chairman. I yield back.
The chair now recognizes the gentlelady from Illinois, the vice chair, Ms. Schukowsky.
Thank you. Mr. Barr, could you describe how we potentially would have been in a different situation today had this agency been in existence as the current problems started to unroll?
Yes, I think we would have been could have been in a fundamentally different situation if we had an agency that could set the rules of the road for everybody to follow. If we had an agency that could say to mortgage brokers, you can't get paid more for offering riskier, higher priced, more confusing products than a basic product. If we had a rule that said, mortgage brokers, you have a duty of care, you have to do best execution for a mortgage, so you can't offer the mortgage that's the best deal for the broker. You're supposed to offer a mortgage that's the best deal for the consumer. If we had a duty that said mortgage brokers have to have some skin in the game, they need to be paid over time. Securitization trusts have to have skin in the game so that you don't have a system where all the bad mortgages are made up front and eventually sold to the investor at the other end with nobody in the chain having responsibility, nobody having any of their own capital at risk. So we could have had fundamental change. We could have had a fundamentally different situation in which consumers were protected at the front end and the financial system was protected all the way through.
And you're
if we had
saying
had this
without
agency.
any change in legislation beyond the creation of this agency, that you would have the authorities then under the bill, which I haven't read thoroughly yet, you would be able to have done all those things?
Yes. This agency would be granted the authority to do all the things that I just described.
Did you want to comment on that, Mr.?
Well, I just say that sort of one of the things that's critical here is APA rulemaking authority, and of course under the new proposal, they'll be able to do it for non-bank as well as bank-related financial instruments and mortgages. And so in the omnibus, you gave us, and for which we are very grateful, APA rulemaking for non-bank mortgages. And we're going to look at that, and we're going to do, I think, a very, very good rule. And Mr. Rush, you have legislation that would expand our jurisdiction a little bit more, but it only goes, but it's only within the context of non-bank issued financial instruments. So 20 years ago, we did a lot of matters relating to credit cards. And all the credit cards are now, virtually every credit card is now issued by a bank. We have no jurisdiction there. So I think that's a critical advantage from the consumer's perspective of what this new agency might do.
And let me just say that while I absolutely, in theory, think pulling it all together in one place is a good idea, but you know, we've seen in the startup of the Department of Homeland Security lots of difficulties in pulling it all together and making it all happen. The creation of a director of national intelligence. Certainly in that case, many of us on the Intelligence Committee see a large bureaucracy itself developing and you know, have some problems with the coordination that was actually supposed to happen. How can we be assured that this will achieve its goals, achieve it in a timely way, and not just be another bureaucracy?
Thank you very much. Again, I think that our view is the agencies that have the authority now should aggressively use those authorities. Those authorities are inadequate to the task. The basic structure of the system was a dismal failure. We need to do this. We need to take this action. The legislation has tight timelines for transition. Treasury has responsibility to make sure that transition happens effectively. You can come see me. You can come see Secretary Geithner. We're responsible for making sure you can hold us accountable.
The chair recognizes Mr. Stearns from Florida.
Thank you, Mr. Chairman. Mr. Chairman, we've had a lot of hearings on privacies here on this committee, and when I was chairman of the committee, we had many hearings on privacy, and I think my concern is that if we transfer some of the Federal Trade Commission's privacy work to this new CFPA, particularly in light of all the expertise that you have, and you've been the leading federal agency in the area of consumer privacy for all these years, and including financial privacy, as well as identity theft, information security. So with that mind, what do you feel about this transfer?
Well, I guess I'd make a couple points. And this committee and you have been leaders on privacy-related issues. You know, we'll be transferring over a lot of laws. We hope to keep sort of a backstop authority that is concurrent. And of course, this is the beginning of the legislative process. It's not the
No, I
end.
understand.
And you know, I see a lot of agreement on many things within this committee on ways to go forward. On grant, I think the way we read the legislation, it was unclear whether issues like data security, privacy would stay with us. I think Mr. Barr is represented today. The better reading of the proposed statute, or the reading of the way the proposed statute will move forward, is that we'll keep issues like that, and I think that's very, very important.
So identity theft you'd still keep?
I think we would keep identity theft.
And
yes.
Financial privacy?
Financial privacy, I think, mostly moves over to the new agency. I mean, again, I think that's to some extent up to you. I think we would keep the safeguards rule under Gramm-Leach-Bliley, but a lot of this has to be worked through. Of course, during the transition period, we'll keep on doing this, and again, we'll have backstop authority. We won't be doing the, and I should probably turn this over to Mr. Barr, who's the one of the true architects of the plan. But
So,
yeah,
what you're saying today is that some of this is still up for negotiation.
Yeah, these boundary issues that you've raised, the same concerns that we saw when we got the legislation at the end of last week. But it seems that it's being resolved on some of these, on many of these boundary issues, in favor of retaining jurisdiction by the existing commission. And I assume that's what, you know, if this legislation moves forward, that's what this committee would be most interested in. But let me turn it over to Mr. Burr. Yeah.
Just to add to that, the chairman is correct with respect to data security issues, identity theft issues, safeguard, red flags. All that would stay at the FTC, and the parallel authority for that at the bank agencies. But the front-end privacy notices that have to do with disclosure would fit in the new disclosure regime of the new Consumer Financial Protection Agency.
So let's say internet privacy, consumer privacy, would that be part of, would that remain with Federal Trade Commission?
Again, with respect to the disclosure aspect on the financial side, the disclosure would be unified with the disclosure regime at the new financial agency. All the data security, identity theft, and related issues would remain at the FTC, and the parallel authorities with respect to banks.
But if you're thinking about core issues like spam, spyware, behavioral marketing, we keep all of those. You know, there might be some issues about whether we're going after a malefactor or a group of malefactors, and one of them is on the other side of the core new agency's fence. You know, right now there's a 120-day waiting period, which we are a little concerned about from the perspective of consumers. But going back to your original point, sort of a variety of issues, including sort of the core privacy issues we do, we'll be keeping and retaining jurisdiction.
Well, I think, Mr. Barr, what you should realize with all that expertise in the Federal Trade Commission, we're starting a new federal agency here. You know, I would think that, as many have pointed out on this side, we're worried about a new federal agency, particularly when you have an agency that already has the expertise. I think the bill says that the cost of this new development of this new agency is such sums as are necessary. Is there any more definitized information you can give on what the cost would be for this new federal agency?
I don't at this time have an overall cost estimate for the agency or size estimate for the agency. It's something we're working on. We'll work with the appropriate committees on and with OMB and CBO on. We anticipate that the agency will be pulling in staff and resources from the existing agencies and additionally having new resources required. I'd be happy to continue to work with you on that question.
Can you talk about the resources the agencies will need besides, I mean, have you identified any of the resources?
We have begun the process of identifying the number of individuals and the other resources the agency would need, but we are not at a place now where I could give you even a reasonable estimate of that. What additional measures beyond the transfer authorities would be required? It is something we are working quite hard on.
I'll just close. Mr. Chairman, you might think as a subcommittee chair, since a lot of the expertise for this is already in the Federal Trade Commission, and this is a new agency, you might and particularly your jurisdiction here. I think we've got to move carefully, as Mr. Dinkle pointed out, of developing a brand-new agency. They don't know how much they're going to spend. They don't know what resources they're going to need. And also, they're going to be taking on expertise for areas they know nothing about that the Federal Trade Commission has years on. So I just wonder, as you as a chairman, you might want to be very careful and cautious about endorsing this new agency without some more hearings on it, and try to get more of the stakeholders here, perhaps more than we have on the witness list here, to try and get into the discussion here. So I thank you, Mr. Chairman.
The chair thanks the gentleman. The chair observes that there's a vote going on the floor. There are 3 votes. It is the desire of the chairman that we should delay the committee hearing for until after the votes are concluded, and then return. I'm not sure what the witnesses what their time commitments are, but it would be very important that you return. I would say within 15 minutes after the last vote, then the subcommittee will reconvene. So the subcommittee, is that all right with you?
Yes, Mr. Chairman.